We're delving into our macro matters now, and this is where we're going to be talking about the European Central Bank, David's favorite numbers, the U.S. non-farm payrolls. Well, I don't know if he knows what they mean, though.
I don't, and I always say, what about the farm payrolls? The poor farmers, don't they have to be measured for the employment they create or lose?
We're going to be talking about that. We're going to be talking about the G20 finance ministers meeting that's taking place or took place in Turkey this week, and all of this and much, much more with Rob Price from ETM Analytics, rather, is an investment analyst. But the first thing I want us to get into is to tap into Rob's black consciousness, because Owen and David have been black consciousnizing around me all evening. We're going to pick up with the conversation that David actually had earlier this week with Bonang Mohale. He's the president of the Black Management Forum. And here he's talking about this transformation barometer that's been launched and making the case for why it needs to exist.
The government is in argument at the moment with the Chamber of Mines about to what an extent are they transformed. The companies are saying we're transformed, we're fulfilled, and the government says too little, too late. Exactly the same thing can also be said about the ownership on the JSE. The president stands up and says only 3%. The JSE says it's more like 25%. So unless you have dispassionate facts, you'll always become unstuck. Then you leave it to the one that has the loudest voice.
Well, those dispassionate facts that Bonang there was talking about, that's what his barometer aims to try and sort out. And we said in the interview, you know, what we desperately need is a measure that everyone can agree on. Rob, welcome to the show. Thanks. Let's kick off with that as the starting point for the discussion. Transformation has become such a hot issue, and no one can agree on how to measure it. So that's why it remains a hot issue.
Yeah, it's a hot issue, and it's interesting, and it's glad that it's great that people are making progress on this issue. But if I can just kind of turn the issue slightly on its head, I can't help but feel sometimes that the government is very focused on these transformation issues, and they become kind of the outcomes of certain policies. And I feel that sometimes if they targeted more ground root policies, they might get the outcomes they're looking for. But they're looking to almost look at the outcomes, and I say we need to find what the real underlying causes of these are. And I saw a story from Indonesia this week that was very interesting from one of the ministries there. The guys are sitting down, they've identified 160 kind of problems in the economy, and they're going to sit down, the whole cabinet, for a full week, they said, day and night, until they've found out the solutions for these problems in order to improve economic growth in the economy. And I think that's how we're going to get real transformation in South Africa, really improving the underlying problems of education, of labor policy, of investment policy, and not just looking at the outcome of transformation on the JSE.
Owen, what's your view on that? Because I've heard this argument before, and an undercurrent of it all is a little bit of, it's a long-term play, it's a long-term game, it's not changes that we can make by just transferring equity. What's your response to that?
Look, I think that there's two sides to this story, but the most important one, in my view, is the side that says we need to redress the differences in the ownership of capital, of the means of capital in the country, for the reasons that were cited in 94 and in all the agreements that were signed at the end of apartheid. And I think that if all these companies that are being subjected to BEE scorecards and being encouraged to change the manner in which they are doing things could just have complied with the government, if they made sure they work hard enough to make sure that all the scorecards are ticked, they go to the government and say, this is what you said we must do, we have done A, B, C, D, E, F. How do we rank, And if they've succeeded in doing that, I think that we wouldn't be having this conversation. It's the same conversation that we're having about the Springboks, whether we should have 6 black Springboks or we should have 17 Springboks or whatever. It's a discussion that brings in a whole lot of emotions. But the bottom line is, with the B in the country, we've got codes that have been stated by the government. So it so happens that we work with some of these companies that are white companies, and we go to them and say, okay, what's going on in terms of B ratings in case we want to invest in them? And you'll find that there's like only one black person on the board, and the person is a non-executive director. And they are not working hard enough to groom management who's going to, for them to say, okay, we've groomed these guys, now they're here, they've been in our business for 6 years or 7 years. You will not find that. The guys are really, in my view, resisting change. And that's why we're always going to have these challenges.
We could have a whole hour on this, but we need to talk about the bigger economic issues. What I always say about transformation, if it was easy, it would have happened already. We know it's difficult. But Rob, let's get on to the last couple of weeks. And China and the US are the two issues that they say are behind this volatility, and yet they're not surprises. Everyone knows about the issue of Chinese growth. Everyone knows the US may or may not raise the interest rates. So we've gone a lot of volatility, as we were saying earlier. Yeah. What's your reading of where we are now? Big picture.
Well, I mean, I think you've hit the nail on the head in terms of the drivers. I just believe these drivers are still bigger than the market is pricing in. I think Chinese economic growth is weaker than people are still pricing. And I've been saying this on the show for a number of weeks and months now, and I still also don't think that the market has fully priced Fed rate hikes. You know, the financial markets have been so reliant on low interest rates, cheap money. That's what's driven asset prices higher. We all know that, and how long can the story go on? And Owen even drew attention to it earlier, that he was saying that even if the Fed were to turn around and provide more stimulus, we're not even sure if that's going to work anymore, or even if it would push up asset prices in the same way as it's done in the past. Because, well, I mean, no two cycles are exactly the same, and surely eventually investors have to ask themselves the questions, are these policies working? And if we've pumped so much money into these financial markets over the last 5-6 years, and yet we haven't resulted in much real economic growth, then, well, there's serious questions to be raised here.
So let me get my finger on what's the biggest pressing economic problem in the world now, because continuously I keep hearing it's deflation. And this is what we need to actually be worried about. And if we look at the European Central Bank and how they've cut their own inflation and growth forecasts, and certainly seem to be suggesting that deflation is really going to become the key issue that we need to be concerned about. Your reaction to both of those, Owen, as well as Rob?
So I think you're right about deflation. You know, Europe is struggling to see inflation push higher. The US is far from getting inflation to 2%, where they ideally want it to be. So that's the one side of the equation that I do believe that Janet Yellen, in terms of making her decisions, she's got everything right. You know, unemployment is improving, etc. People are buying houses, they're going back into the house market and stuff like that. But they just can't deal with inflation. Why? Because they are failing. Despite pumping in so much cash into the system, it looks like people are servicing their debts instead of actually spending. So the economy is growing, the prices push higher. And that's a problem we have in Europe as well. And I really think that the other challenge that the guys, or rather the international investment management community has been ignoring is the fact that at some point China is going to, you know, get tired. And it's tired now. And I would think that this kind of thing would have been priced in already by now, Rob. But it looks like the guys are still reacting to China growth slowing some more, you know.
Rob, come in on deflation.
So on inflation, I think it's a really important thing to talk about. And to say that there's not been much inflation in economies over recent years is actually incorrect. We haven't seen much inflation in consumer prices, but in asset prices, we've seen incredible amounts of inflation. So what central banks have done is they've pumped all this money into these economies, into financial markets, lowered interest rates, and unusually now what we've actually seen is the money go into asset markets and not in consumer markets.
The consumption.
So that's kind of one point to raise. Two, is deflation in consumer markets such a bad thing? I mean, we all want sales. We all want sales at the end of the month. We want to buy prices. We want to buy goods at cheaper prices. So why is deflation such a bad thing for consumers? And I would contest the central bank logic that we need to continue targeting higher inflation, particularly when it's not actually resulting in much positive outcomes in the economy. And I think what they're actually much more scared of is deflation in asset markets. That's incredibly concerning for asset managers, for hedge funds, for banks, understandably. But at some point, these markets have to correct. You cannot continue going up and up and up without ever having a correction.
Let's move on to the local scene. You first, Rob, and then Owen. The Saki Business Confidence Index, 16-year low. Now, that is about perceptions as opposed to behavior, but perception drive behavior.
Yeah, it's incredibly worrying. I mean, unfortunately, all the data we're seeing coming out at the moment is incredibly negative, and it's a trend we've been speaking about for quite some time. Chances are we're going to go into recession in Q3. I think it's an incredibly strong likelihood. And I think it's important to highlight. I was looking at the data just this week on the GDP. So we might move into recession in Rand terms in Q3. If you look at South African GDP, denominated in dollars, because we live in a global world of dollars. We need to think about our incomes in dollar terms. If we think about South African GDP in dollar terms, we haven't expanded the economy since 2011. The economy is doing incredibly poorly in dollar terms, and that just accentuates just how bad the kind of structural decline in the economy. And we've moved from something around a $400 billion economy, and now we're approaching a $300 billion economy. That's a 25% cut in the size of the economy over those years, and that's incredibly concerning.
I like the phrases that you've used there, a structural decline in the economy. Do you see the same sort of impediment that's leading to what's now being termed pedestrian growth?
Yeah, I mean, there's no doubt, you know, people 10 years ago when you spoke about South Africa, people would think mining. But now we talk about the asset prices of these mining companies. We know there's been a lot of decimation that's happened there in the past 3 odd years. You know, I mean, Anglo-American trading close to like $140. I mean, that's quite a big move. Lonmin, $6 all the way from north of 300. You know, Implats, everything that is in the space has lost value. It means obviously we can't get the revenues we had been expecting to collect on a tax perspective. So the country naturally is going to have to deal with big deficits and stuff like that. We need to start thinking about what we need to do as a country. I saw a headline today that spoke about the government considering reducing its labor force. But unfortunately in South Africa, we know it's going to be doi time.
I want us to take a bet, because I think this, so remember when SACI released their business confidence index, I think it was about last month, Brand South Africa stood up and said, this is wrong, this isn't a fair reflection of what's actually happening in the economy. My bet is this, with this BMF transformation barometer, so once the first publication of the barometer comes out, somebody is going to stand up and say that this barometer is wrong. And the problem with this, who owns the index? So SACI owns the index. The BMF is the motherboard of this particular transformation barometer. I think this is going to be the hotspot of a new conversation and a new debate in South Africa, because nobody's going to believe that that barometer is accurate.
I think you're always
100 rand on the table.
You're always going to have questions on these data.
Well, no one's going to bet against you, so put a lot more on.
Jeez, man.
That's an easy bet.
Just to build on what Owen was saying, though, wouldn't you say, though, I mean, you were saying that, like, kind of the, you know, the mining and the commodity slowdown has been a major concern in South Africa, understandably, but we were still running an imbalanced budget and trade account in years before the commodity and mining slowed down. So I would contend that the South African policymakers have to kind of look internally here and not just say it's an external problem. I think we could have been doing more. We should have been doing more in the good years to prepare for the lean years. And the South African government has continued to work along thinking that these great years of harvest were just coming into the future. And the fact is, unfortunately, the lean years are just getting leaner and leaner.
There's also this dangerous thing of saying, oh, well, look, the global economy is in a poor position, not our fault.
Yeah.
100%.
But then you say, well, the Reserve Bank and the Treasury must look after the rand and that kind of thing. Actually, there's a lot the government can do as well.
Yeah,
the buck, whether it's weak or strong, stops with government, not the Reserve Bank.
Yeah, look, I mean, I think there's a lot of internal interventions that could have been done. I mean, I heard in the news yesterday that there's 19 billion rands being paid to ghost employees in the Northwest. I mean, little things like that, honestly.
We're living in the wrong province.
You know, so it's definitely a lot of local intervention could have been done. The policies could have been engineered right. I think we control some of the biggest global mining resources in the world. So we should have made sure that we get into the right relationships. When China came through to the fray and led growth in the past 10 years, we should have had an upper hand in negotiating against everyone else.
That is the worst thing. That is the worst advice.
There's a book I'm currently reading. It was written by a gentleman from Kenya. It's called "It's Our Time to Eat." So people are still eating for now.
It is our time to eat. If you've got a copy of that book, let us know and let us know what's the biggest lessons you're picking up from it. Let's give a big thank you to Rob Price from ETM Analytics for joining us, and of course Owen Komo from Inkunzi Investments.